Hello, it's Robert Miner with Dynamic Traders Group with this week's short video for our YouTube subscribers and Twitter followers. It's where I do a relatively short video about one or two markets which might have a trade set up in the following week to give you a little bit of introduction of what we do in our longer videos and educational projects for our DT Report subscribers. If you like these videos, please subscribe below so you get notified whenever we have a new one. Hit the like button if you think it's useful, and also share it with your friends. Let them know about it if you think it might be helpful. So today we're going to talk about the S&P, everybody's favorite market, and the relationship to potential trade setups, reversals, trend continuations, that sort of thing, when we come into a CPI report. Next Tuesday on I think it's the 14th, is the monthly CPI report, and oftentimes there's reactions to that report. I'm going to show you how we can look at the technical position of a market going into the report, not knowing anything about what the probable report's going to be, but going into it and how we can use that potentially for a very specific trade setup. So let's get started and let's be prepared for Tuesday's report and potentially how we might use that information for a specific trade strategy. This is a chart of the ES, the daily chart, and it's just closing data. We can get rid of a lot of the noise just by looking at closing data. And I've got marked off the past few months of the CPI report. And of course, because inflation is very much in the news in recent months, the CPI report is greatly anticipated and frequently has at least a small reaction within the market following the report. What we want to try to understand is, what is that reaction likely to be? Let's just go look at the last few months of reports. Here's the September report that was released on September 13th. The swing high, followed by a pretty consistent multi-week decline, occurred the day before the CPI report. Why do I have this as a red line here? Well, I want to look at the report in the relationship to where the momentum cycle is when the report came out. So when the September 13th report came out, is that our daily momentum cycle was overbought. It was in a position from where daily highs are typically made, and then the trend is going to be sideways to down for a few days. So more than likely, the report would result in a high being made, let's say plus or minus a day, either side of the report. I'm going to show you how we look at the higher time frame weekly trend in a minute. Let's now focus on just the daily cycles. Let's go down to the October 13th report. On October 13th, I have a green line here because it represents that the daily momentum cycle was either oversold or bullish and not overbought. And that's exactly what it was at this time. So if we had other technical evidence that there's a possibility of a market low being made, a swing low, the CPI report might be the catalyst for that, and that's exactly what it was. Report comes out, the public's sensitive to it, the market was in a position to make a low. I don't know what the results of that report were, but the point is we don't need to know that. We just need to know the report is coming up, and it's a report that in the current time frame is relatively sensitive. People are very interested in it. Let's go to the November report, November 10th. Where was the market at going into November 10th? Well, it had been in a bull trend for a while, and the momentum cycle was nearing overbought. It was nearing a place from where what we call daily highs were made, where the market would be sideways to down. Well, that's exactly what occurred. One day after the report, on the 11th, was a minor swing high. The market just went sideways for a number of days, and then it did make a new high. But the report came when the momentum was nearing overbought. Typically, the result of that report would be sideways to down for at least a few days. Exactly what happened. How about the December report, December 13th, right where this red line is? And it's red because as of the 13th, going into that day, our momentum cycle was just reaching overbought. So more than likely, the market's within a day or two of making a momentum swing high, and oftentimes when it's in that technical position, in that position within the daily momentum cycle, is that the report is the catalyst to complete at least a short-term high and then be sideways to down, at least for a number of days. And then how about the January report on January 12th? Well, January 12th, the momentum cycle, the daily momentum cycle, was clearly overbought. It had been overbought actually for a couple of days. So the day after that report was a short-term high, but only a short-term high lasting just a few days. Where are we at as of right now? Well, the next report is this coming Tuesday, February 14th. Let's take a look at where our daily momentum cycle is. It's already oversold. So more than likely, we're going to have a reaction against that report on the upside, sideways to up for a few days. How big a reaction do you think that might be? And how do you think we might be able to be prepared for how big of that reaction, how important a low might be early next week? Is it going to last a few days or is it going to last a few weeks? Well, that's where we want to know where the higher time frame cycle is. So let's add on to our indicator window here. What I have in Dynamic Trader, it's called, it's a dual time frame window. And we're going to put our weekly cycles, overlay them in the overbought and oversold zone. So that's what we're doing here. We're showing the higher time frame weekly momentum cycles. The light green cycle just in the oversold zone just indicates that the market is oversold on the weekly momentum. The darker green means it's actually bullish. The weekly momentum cycle is bullish. Light red, the weekly momentum cycle's overbought, warning that a weekly high should be near. The dark red indicates that the weekly momentum is bearish and not oversold, meaning that more than likely the weekly cycle will be sideways to down for a while. Let's go back again. Here's September, our CPI. Our daily momentum was overbought, and look at where our weekly momentum is. The weekly momentum cycle was already bearish. So when you get a smaller time frame, daily momentum makes a bear reversal within a weekly momentum cycle, it's already bearish. That's a dual time frame momentum cycles in the same direction. That's where you usually have the stronger moves. And bingo, strongly down for a few weeks here. So very significant decline. Let's take a look at this October. October, the daily momentum was oversold going into that CPI report, and also the weekly momentum was oversold. So we're at or near a weekly low when the daily momentum made a bull reversal actually on the day of the CPI report. So we had a report that was a catalyst that completed a weekly low, and then the market was bullish for several weeks. Where are we at in November? In November, we know that the daily momentum was just reaching the overbought zone, and it was actually a few days later, the beginning of the next week, that the weekly momentum reached overbought. So we have daily and weekly overbought. So the market was essentially sideways, not much upward movement. So we would expect at the November report that more than likely that might be the catalyst to complete this bull trend that actually began at the last report. How about the December report? Again, both the daily and the weekly momentums were overbought or bearish, so we had a more significant decline because going into that report, it was the catalyst to complete just a 3 or 4 day correction and then continue the decline. How about going into the January report? Going into the January report, the daily momentum was overbought. Now here's what's really important. However, the weekly momentums were bullish. So when we have a daily momentum cycle is overbought and makes a bear reversal against a weekly bullish cycle, usually we just have a 3 to 5 day correction against the weekly trend. Exactly what we had here. Okay, here we come up. 2 days, the CPI report, February 14th. What do we know going into next week? We know the prior couple of weeks, the weekly momentum has been overbought, so we should be at or near a weekly high. Yet the daily momentum going into the early part of next week is going to be oversold, indicating a daily low. When you have a daily momentum make a bull reversal, while a weekly momentum is overbought or bearish, what does that usually result? It usually results in just a few days sideways to up before the higher time frame weekly momentum, which is overbought or bearish, continues and the market sideways to down. So if by chance the ES is sideways to down into early next week when we have the CPI report, and if it appears that it's going to make a low and then continue to advance after the CPI report, I don't care what the numbers are, the upside should be very limited, probably just to 2 or 3 or 4 days before the weekly trend continues to a new low. So let's take a quick look at the weekly data. This is the ES weekly data, and look what happened this past week. This past week is the weekly momentum made what we call a dual look-back bearish reversal, similar to what was made back here in December, early December, similar to what was made back here in the middle of August for these weekly highs. Now, this doesn't necessarily mean it's going to be a weekly high of the same degree of these, but more than likely, the market's going to be sideways to down for 2 or 3 weeks. This bearish reversal is not reflected in the daily data through Friday. Beginning Monday on the daily chart, this is going to be dark red, like back here, representing that the higher time frame weekly momentum cycle is now bearish. So any advance that's made from the daily momentum cycle should be just 3 to 5 days sideways to up before then the higher time frame bearish cycle continues. So that's what we would look at early next week, regardless of what numbers come out. If there's a positive reaction to this CPI report, keep in mind it should be very short term, last 2 or 3 days, followed by a resumption of the bearish weekly trend, which should probably continue for another 3 to 4 weeks. That's it for today, my friends. Please subscribe below, like below if you saw this or found this information useful, and check us out at dynamictraders.com. Check out our Traders News. Join that membership. Costs you nothing. Just need your email address. That's it for today. I'll see you again in a week or two. It's Robert Miner, over and out for now.